Now let's take a look at the bigger picture. I have not seen Art Hogan in a long time. Really excited to chat with Chief Market Strategist, B. Riley Wealth Management, Art Hogan. Great to see you, Art Hogan. How are you? Good to see you, and you're still doing this. What do you think now as we're at records?
Yeah, so great to see you too, and welcome back from vacation. I would tell you this, that the market's done a pretty good job of recovering from the worst thoughts about trade and post-April 2nd on Liberation Day to rallying back to all-time highs. But I think it's doing that with an assumption that the tariff rates that the UK decided were okay to do a deal with were what everyone else was going to see. And since then, we haven't heard of any other deals, and we certainly have heard a lot of noise around trade and tariffs. So I think that's going to cause a bit of volatility. Luckily, this week is a week where we kind of kick off earnings season, so we get at least that distraction. And so far of the 50 or so S&P 500 companies that have reported, 87% of them are actually beating their revenue estimates, and 77% are beating their earnings estimates. So the earnings reporting season is going to be a positive catalyst, while there's a lot of noise around trade and tariff, and we've got till August 1st to figure out really what the rules of the road are here.
Yeah, I mean, good news so far to see some beats. We're so early on. It's been a lot of banks, and those were likely to beat. Each sector, will start to get a lot more throughout earnings season. Overall, do you feel that earnings season can be taken away as good news by the time we finish, or are things just too uncertain? It's all about the guidance, right?
Right. Yeah, and remember, for the first quarter, we really didn't get any guidance because there was so much uncertainty around trade policy that companies were really given a pass. So that's different this go around in the second quarter. But because there was no guidance given and there was so much uncertainty around trade policy and getting that big, beautiful bill passed, that the estimates really were very achievable, right? We're coming in FactSet had gone from something like 12% earnings growth on a year-over-year basis down to about 5%. And right now we're on a run rate to get closer to 10% earnings growth. So that's clearly going to be a significant upside, and I certainly think that's going to be seen positively. But to your point, it's how companies guide and how many companies have to talk about mitigating tariff risk and how they're planning forward. I think that's going to be more good news than bad news. And I certainly think that actually having guidance will give us a better read on both the next quarter and certainly the rest of this year. So I see earnings as a real positive here, and what otherwise could be a quagmire until August 1st when we figure out what the end game is in this trade war.
Yeah, I mean, we already heard from Indonesia, right? We're going to maybe get some more deals coming. How about the end of the year? Do you see more records? Do you see us above, 6,300 and higher? Do you have year-end targets?
Yeah, my year-end target is 6,500. It's been there all year. It doesn't feel as courageous now as it did, back in April and certainly at the beginning of the year. But I think if you use the same multiple that we've closed at on a trailing basis for the last 5 years to what we suspect we'll get for earnings, which is between 275 and 280 for the S&P 500 for this calendar year, we'll likely be able to see 6,500 as a base case. The upside. I think that's not going to happen in a straight line. There's a lot of things that are going to bump around. Certainly the month of August and the month of September are always tricky for us, but I think we end up washing out a lot of the noise around trade. We certainly get to know what the end result of the goods inflation will look like, and the Fed at that point in time will likely be able to cut rates maybe a couple of times, thinking September and December.
Yeah, understood. I like how you threw that in. It's not going to be in a straight line, like no way, right? With every headline that even today we saw the crazy move with whether or not Powell will be fired. It seemed like it was imminent, and then it was like highly unlikely that it's happening right now. When you think about how to make money, what do you tell investors? I mean, NVIDIA is a name that has been incredible, hit new highs again. Is that something that you recommend for the long term?
Yeah, the mega cap technology stocks have been on our barbell approach to looking at investing, and that's been true for the last 3 years. And what we mean by barbell is, on one side you've got this beta, right, mega cap technology, and then you offset that on the other side with things like industrials, financials, and healthcare. And what you have to do is you have to rebalance that every quarter. So what you're actually doing is is you're selling some of your winners along the way, taking profits in some of these mega caps, so you keep that barbell balanced. And that actually, if you've followed that barbell approach over the course of the last 3 years, you've outperformed the S&P 500. It helps you ride this out and not get overexposed to the volatility around some of the big cap techs. But it also gets you involved in things that are actually catching up here. Industrial is one of the best performing sectors this year. It's a derivative play on artificial intelligence for sure, but it's also a play on the infrastructure build-out that we're doing, rebuilding the energy grid, and all types of things. And heaven forbid, if household formation starts picking up again and home building picks up, the industrials have a key play in there too. So I think keeping that approach, picking the right sectors that are catching up this year. Financial is certainly a big beneficiary of deregulation. Industrials proving themselves out, and we certainly think that healthcare is going to be a great play. Johnson & Johnson is just the tip of the iceberg here, as some of these big large cap pharmas start to report, and M&A is actually allowed in this environment of deregulation.
So deregulation, you like what's going on there. Healthcare, you said maybe something good with deregulation, more M&A activity you mentioned, and that's something that people are really hoping for when they try to invest in the financials. Do you think
that
the
really
financials?
is? Yeah, you bring up such a great point. I mean, we have north of 4,500 financial institutions, banks, basically, and to run a bank when you're not at scale is very difficult with your compliance and legal costs on top of your technology spend. So it's not as though the money center banks like JP Morgan, Bank of America, Citibank are going to be acquiring anybody, but there's a lot of regionals that could consolidate and be run much more proficiently. So we're probably overbanked, but there just hasn't been an appetite for mergers and acquisitions for the last 5 or 6 years. I think that starts to pick up. We're already starting to see some of those things, and I think the financials sort of they certainly sit in the catbird seat for where that happens. They're also beneficiaries of things like less regulation. So if this SLR passes, more money to lend, more money to buy back shares, and more money to pay dividends.
Have you been a fan of those dividend aristocrats, like those oldies but goodies? Have you had names that have served you well over the decades that you're still in, Art?
Yeah, so taking a look at our it's so funny you should mention that. So taking a look at our dividend list, we have about 12 names on it. All of them are household names that you would recognize. AbbVie sits on there, Johnson & Johnson's on there, Bristol Myers on there, Pfizer is on there, and then we have 3 energy companies that sit on there as well. So to me, I think that's a very intuitive way to look at things, especially if we start to think that interest rates are going to normalize. We think the 10-year at the end of the year is 3 3/4 to 4 1/4 in that range by the fourth quarter. We'll probably be stuck in this 4 1/4, 4 1/2 range until we get to the other side of this quarter. So I think that as we look at that, it's going to just make those dividend aristocrats that much more attractive.
All right. Art Hogan, great to see you. And check him out on Twitter with his 2 spaniels. Those dogs are so cute, Art. I love when you post the dogs. It makes me happy.
I'm asleep
so
right at my
keep
feet
doing
right
that.
now. I'm surprised I didn't hear your voice and start barking.
Art Hogan, thank you. Good to see you.